Is there a credit repair conspiracy? You better believe it. And it starts with the banks, because the banks don't want you to improve your credit score. But first we have to talk about how banks make money. When you deposit money in an interest-earning account at a bank, they pay you a small amount of money as interest on your deposit. If you've had a savings account at any time in the past several years, you know that the interest you get paid isn't a lot. In the last 10 years, the range has probably been from 1 to 5%, depending on the type of account in the bank. Most banks have fees of various kinds associated with different accounts, which help to offset the operational costs of offering those accounts. Some of these fees have evolved into things like overdraft lines of credit, which amounts to an insanely expensive loan from the bank and have turned into key profit generators for many banks. And this brings us to the real question. Where does the bank make their money? For every dollar that is sitting in checking accounts at any given bank, they probably have somewhere in the neighborhood of around $10 or $20 in outstanding loans. It is through those loans that the banks make their money. It goes something like this. You deposit $1 and get 1% interest on that dollar. That means you'll get 1 cent per year for that dollar. The bank loans out that dollar plus 9 more pretend dollars and makes anywhere from 5% to 29% on the $10 loan. So while you're making 1 cent per year on your dollar, the bank might be making over $2 per year on the money they loaned out at a 20% interest rate. As you can see, if the bank is only paying you 1 cent per year for that dollar and charging fees for using tellers and checks, you're not getting much compared to what they are getting out of that same dollar. In this admittedly oversimplified example, the bank makes somewhere around 200 times more than you do for every dollar you deposit. And they make that money by issuing loans to consumers. The higher the interest rate is on the loan, the more money the bank makes. So while high interest rates on loans are bad for you, the consumer, they mean more money for the banks. Managing risk. Of course, there is always the risk, especially with regards to unsecured debt, that a consumer who won't follow through with their obligation to pay back a loan. The bank offsets those costs by doing 3 things. 1. Charging more for loans to consumers with a history of defaulting. More fees, more interest, more money. 2. Selling loans in default to bill collectors. 3. Getting a tax write-off for losses on loans that go south. To better understand how this works, let's look at an example. For the sake of this example, let's say that a certain category of consumer, one with bad credit, gets higher interest rates because of past defaults. Let's say, for the sake of illustration, that 30% of consumers in this category eventually default on a loan. 3 out of 10. So out of 10 consumers with one $10,000 loan each for a total of $100,000 in loans, 3 consumers will default on $30,000 worth of loans. Let's take those 10 consumers and look at what happens. Each consumer pays roughly $100 per month in interest for the loans at 20% interest. In addition to this, about $100 each month is going to principal. Since 7 of the consumers will pay off the loan in about 8 years, the bank will make around $75,000 off those 7 loans. But what about the 3 consumers who don't pay? If they pay on their loans for an average of 2 years, the bank will make roughly $2,300 per consumer in that 2 years. Another $2,400 per consumer will have been paid towards the principal. So the bank has an outstanding balance of $7,600 per consumer in default. They then write that balance off, which reduces their taxes. They then sell that $7,600 bad debt to a collection agency who pays $1,140 for the bad debt. At this point, the bank has received $2,400 in principal payments, $2,300 in interest payments, $1,140 from the sale of the loan, not to mention the tax savings from the write-off. That's a total of $5,840 received on the 3 $10,000 loans, making it a total loss of $4,160 times 3 loans, or $12,480. Do you remember how much the bank made off the consumers who didn't default? $75,000. $75,000 minus $12,480 equals $62,520. And that is on bad credit loans. These numbers are based on 10 loans at 20% interest with $200 per month payments on which 3 of the 10 consumers eventually default. What good credit costs a bank? Let's take the above example a step further. Let's say that the 10 consumers that the bank loaned the money to were in a different category. They had good credit, that according to statistics, they rarely default on loans. So the 10 consumers would get their loans for $10,000 at perhaps 10% interest instead of 20%. With the same loan amount and the same $200 per month payment, the 10 good credit consumers would only pay $2,848 over the life of the loan. The math here is simple. $2,848 times 10 consumers equals $28,480 profit on those 10 consumers. Remember how much profit was in our bad credit example? $62,000 was the rough estimate. $62,000 minus $28,480 equals $33,520. And there is the answer. Loaning $10,000 to 10 consumers with good credit versus 10 with bad credit could cost the bank $33,520. Where the money is. We know that there are more numbers involved in the bank's operations, but we have given a simplified example here to illustrate this point. The banks make more money on higher risk loans with higher interest rates. And even at a 40 or 50% default rate, the numbers remain very attractive for the bank. The real money is in high interest loans or subprime loans. The trick for the bank is getting consumers that are risky enough or desperate enough to pay higher interest rates, but reliable enough to keep the default rate within the limits needed to maintain profits. And that's where the credit bureaus come in. Credit Repair Conspiracy Part 2 is the bureaus. In Part 1 of our Credit Repair Conspiracy series, we talked about how the banks make money and how they can make more money from consumers with bad credit. In order to find the most profitable consumers to make offers to, the banks need to have a pool of data that includes the types of consumers they are looking for. An example, consumers with subprime credit. And that is where the credit bureaus come in. The data business. Credit bureaus are in the data business. They collect and sell data. Banks are the credit bureau's main customers. The banks go to the credit bureaus to get the data they need for marketing to consumers. As we discussed in Credit Repair Conspiracy Part 1, the most profitable consumer for the bank is one with bad enough credit to justify a higher interest rate, but still fairly good chances of keeping good on their promise to pay the loan. So, bad credit data is in high demand. And this is where the issue comes in. As a business, the credit bureaus naturally want to sell their customers the kind of data they want. And since bad credit data is in high demand, the more bad credit data they have, the better off they are. The banks are happy, the bureaus are happy, and the consumer gets screwed. This is where the credit repair conspiracy really comes into play. In very subtle but calculated ways, the credit bureaus do things that shape their data on a large scale to give their customers, the banks, what they want. Anyone who has ever had a legitimate error on their credit report can tell you that it can be a real pain to get things corrected. You would think just writing the bureau would be enough, but it isn't. Letters get ignored, incorrect items get verified, and consumers get the shaft. It's not by accident either. The whole system is designed that way. Repeat, the credit system is designed to hold you down. It's a kick you while you're down and keep you there sort of system. Once you've been buried, it can be quite difficult to get things fixed. An article on smartmoney.com in 2009 described just how difficult it can be. Quote, and even a successful lawsuit won't necessarily fix a mistake. Just ask Chino, California marriage counselor Jeff Christensen. In 2003, the cable company Charter apologized to him for reporting a collection account in error and directed the credit bureaus to delete the information. Experian refused, so Christensen took the bureau to court. In 2005, a judge ruled that Experian was violating the law and fined the company $2,500. Experian paid the fine, but it didn't correct the error until December 2008, when Smart Money called saying it never got the right paperwork. Turns out, the courts can issue fines, but they can't demand corrections. You have no right to an accurate credit report, says Linclip, the attorney. Consumer advocates estimate that bureaus pay just $25 million a year in court fines, a minor expense for the $7 billion industry. Why would a credit bureau care so much about keeping negative information in a file so as to refuse to delete information that the creditor reported in error? The answer is simple. Negative information is just too damn profitable. Race and religion. Throughout history, people have been discriminated against time and time again because of things like race and religion. Just because someone was a member of a particular race or religious group, they were either safe or in trouble. Do not think that your race or religious heritage will save you in the credit system, though. It won't. There are very rich, very powerful people who profit hugely from the massive amounts of people with bad credit and errors on their credit reports. Your race or religion doesn't matter to them. The only thing that matters is that you stay profitable. They want to lock you into the bad credit position. The credit repair conspiracy. The credit repair conspiracy is about the banks and the credit bureaus working together to create a system in which consumers are categorized and herded like virtual cattle into the most profitable segment they can be shoved into. Periods of lenient lending are followed by periods of credit fallout where consumers who received loans can't pay them. And guess what those periods of lenient lending create? More people with bad credit. And once you're in that pool, the credit bureaus want to keep you there. Why would they care? Because banks are the credit bureau's main customers. And banks want desperate buyers, consumers with bad credit and not a lot of choices. They want people who have no choice but to pay high interest rates on loans. And the credit bureaus do their best to give their customers what they want by designing the whole system, from the reporting format to the dispute process, to hold you down. From the credit bureau's resistance to deletion, both directly with consumers and instructions they give to lenders for using their systems, to the bank's tricks and tactics for keeping customers profitable, such as the much publicized Capital One practice of withholding credit limits. To make consumers look less attractive to other lenders, the credit system is designed to hold you down and make you as profitable as possible for the banks and the credit bureaus. And that's what the credit repair conspiracy is all about. For more videos and to learn about the Credit Repair Intelligence System, visit our site at creditrepairpublishing.com.